Welcome to Invested Insider, your trusted source for the latest financial news and insights. My name is Jason Reynolds, and today is the 3rd of August of 2023. Today, we're focusing on the impressive performance of the S&P 500. Over the past few months, the S&P 500, the benchmark of the U.S. equities market, has been on an unexpected rally. It's edging towards a 5th straight monthly gain in July. 8 months ago, this trend seemed far-fetched. As a result, equity analysts at big banks are revising their S&P 500 targets upward. Looking back, many analysts may have underestimated the resilience of U.S. corporations, consumers, and the broader economy. These entities were put to the test by higher interest rates, and they not only held their ground but also demonstrated an unexpected buoyancy. The positive effects of inflation on long-term corporate profits were also overlooked by many. This oversight, coupled with the resilience of the economy, has led to stocks proving resilient to higher bond yields in 2023. However, it's important to remember that this resilience to higher bond yields might not always hold true. For instance, financial markets professional Jawad Mian has suggested that rising real yields could eventually hit a tipping point that could significantly drop U.S. equity valuations. He proposed that we might be on a path of discovering how high interest rates can go before the economy shows signs of strain. According to him, the 10-year yield could potentially rise as high as 5%. Let's not forget about the Federal Reserve's policy, which has pushed interest rates to their highest level in 22 years. Further hikes could potentially push long-dated bond yields higher. Foreign investors, especially in Japan, could decide to divert from U.S. Treasuries to more appealing yields back home. We saw a preview of this when news about the Bank of Japan's plans to tweak its policy led to an increase in the yield on the 30-year Treasury bond above 4%, sparking a sell-off in stocks. Of course, corporate earnings are another integral part of this puzzle. Higher yields make bonds more attractive to investors, consequently reducing the appeal of stocks. They also hike borrowing costs for corporations, potentially eating into profits, and pushing companies towards cost-cutting measures like layoffs. Currently, the forward 12-month price-to-earnings ratio for the S&P 500 index is higher than its 5-year average, which indicates a lofty valuation. For the current momentum to continue, corporate earnings need to keep pace with the increasingly optimistic expectations. Even though profits are projected to contract by 7% in the quarter that ended in June, there's a forecast for significant growth of 12.6% in 2024. If companies meet or even surpass these expectations, stocks will likely maintain their gains or continue to climb. But disappointing earnings growth could potentially lead to a painful market correction. Despite the encouraging rally this year, with the S&P 500 rising 19.3%, the Nasdaq Composite climbing by 36.8%, and the Dow Jones Industrial Average going up by 7%, we must not forget that 2022 was the worst year for stock market performance since 2008. The recovery has been encouraging, but the future is dependent on the strength of corporate earnings in an environment of rising yields. So, as we can see, it's all a balancing act. Stay informed, do your due diligence, consult with your financial advisor, and make the most informed decisions you can. Until next time, this has been Invested Insider. Stay informed and stay prosperous.
The Invested Insider podcast does not offer any financial, economic, legal, accounting, or tax advice or recommendations. The information provided in this podcast or on the associated blog should not be construed as investing or financial advice and should not be considered professional advice. The views, opinions, and content presented in this podcast do not represent the endorsement or approval of Invested Insider and assumes no responsibility for the accuracy or completeness of third-party materials or content referenced in the podcast.